Welcome back. Well, we're holding well in the green. The Nifty is still holding on to that 45-point gain. The breadth of the market is well good, and the Nifty Bank is participating a little bit. It's up 150 points out. Well, let's focus on India's household debt. That's hit a new high. The outstanding non-financial sector debt touched $5.85 trillion. That's equivalent to around 168% of the GDP. But Motilal Oswal Financial in a recent note said that India's debt to GDP ratio is still much lower than other economies. Well, we have Nikhil Gupta, the chief economist at Motilal Oswal Financial Services, who joins in. Hi, Nikhil, good morning and good to see you. Ben, basic point, should this be a cause of concern?
Hi, Nijal. Thank you for having me on the show. Yes, you are right that India's debt to GDP is close to 169% of GDP. I do not see, as such, the aggregate numbers, although they have risen in the past decade. I do not see it as a serious concern on an aggregate basis, primarily because, as you mentioned, one, it is still very low compared to other emerging markets or major countries in the world. We have given data in our report, and just for the benefit of the viewers, most of the developed markets are more than 200%. Most of them are actually close to 300%. China itself is more than 300%. India is still below 200%. And again, the composition is where we need more focus rather than the aggregate numbers. So no, to answer your question, we don't see it as a serious cause of concern at this point in time.
Okay. You don't see it as a serious cause of concern. But, you know, another important internal that a lot of economists track and a lot of market observers track as well is the debt to GDP ratio, right? Over there, if you look at it, it's much lower than a lot of major nations. Can you tell us what is the debt to GDP ratio right now, and what is the kind of expectation that you have? And from a, say, risky asset class standpoint, how should one view it?
Right. So, Sonia, as I mentioned, India's debt to GDP ratio, when I say debt to GDP ratio, we include three sectors primarily: government, household, and non-financial corporate sector. So combining the debt to GDP ratio of all these three sectors, India's debt to GDP is close to 169% of GDP as of December 2023. Again, these are our estimates. Unfortunately, there is no official estimates which provide quarterly data on the private debt in India. So we are close to 169% of GDP based on our estimates, which is, as I mentioned, much lower than anywhere close to 280 to 300% of GDP in the US, in many European countries, and in Japan, it is more than 400%. In China, which is the largest emerging market, it is above 300% of GDP. So we are comfortable when we compare our debt to GDP vis-a-vis other countries. I don't see any concern as of now on an aggregate basis.
Okay, in your report, you have written the centre's debt stood at 59% of GDP in Q3, which is close to an 18-year high of 59.3% in the previous quarter. So both in terms of centre debt as well as state debt, you are not concerned with the rise that we've seen?
So centre's debt, yes, you are right. The central government's debt is close to 59%. It is close to where it was COVID. And in fact, in FY24, the first 3 quarters that we have estimated, it seems that it has increased vis-a-vis the last year. So from FY21, it had fallen, but in FY24, it has increased again. For states, it has been very comfortable or very stable at close to 27% of GDP over the last 2 to 3 years. So since COVID, it has not increased much for states. Again, this is something that has happened worldwide, post-COVID, post the pandemic. Government debt to GDP ratio has increased everywhere in the world. And the only point that we need to be worried about is that it has increased in FY24. But again, it has increased primarily because the base of my debt to GDP, which is nominal GDP, the growth in nominal GDP was very weak in FY24. FY25, we expect, and the general consensus is also that nominal GDP growth will be back to 10.5% to 11%, vis-a-vis 9% that we expect it to be in FY24. So I do not see the debt to GDP ratio for the central government or state governments going up in FY25 or forward beyond FY25. Having said that, I'm also of the view that debt to GDP ratio for the government is not going to come off very sharply or very quickly over the next 5 to 10 years. It is going to be a gradual process, and I think that is how it should be. So probably we will be seeing debt to GDP ratio of the government, center and states combined, close to 80% a few years down the line. And we expect it to be over 60% of GDP even by the end of 2030's decade, which means 15 years down the line.
Okay. Nikhil, morning, Prashant here. The other big, when you talk about debt, household debt, etc., there's household savings as well, right? And there's been such a big debate recently with banks on one side and mutual fund CEOs on the other side. And each side has been kind of saying, actually, the allegation which is made is that a lot of the bank deposit which should go to banks is actually finding its way into the market, into mutual funds, etc. I just wanted to get your thoughts. If you've thought about that, and how do you think about this one? Is it really happening? And there are counter arguments to when you talk to mutual fund CEOs. I mean, there are counters to this as well. So just your thoughts.
Hi, Prashant. Right. So yes. So when we talk about household savings, there are three parts to it. One is physical savings, which we'll keep out of this discussion because your question is based on financial savings. The other two parts, there is gross financial savings and there is financial liabilities. Now, what matters from the economic perspective is the difference between these two items, which we call the net financial savings. So net financial savings is the difference between gross financial savings and financial liabilities of the household sector. Now, when we focus on gross financial savings, which is where your question is directed to, almost half of India's gross financial savings are in the form of bank deposits. Mutual funds or the exposure that Indian households have in the risky assets, which we call the equity market, is still less than 10%. The important point to note is from FY17 or the last 7-8 years, the share of or the exposure of households in this risky market or the equity markets has actually increased. It was close to 3-4%, let's say in mid 2010s, and now it is close to 8 to 9% of gross financial savings. At the same time, since bank deposits are the largest item, we have seen a fall in bank deposits. So the share of bank deposits have come down, and it is very clear from the fact that gross financial savings have not gone anywhere in the last 7-8 years. In fact, there has been a slight dip in gross financial savings. So to answer your question, yes, there has been a little shift from bank deposits to the risky assets, mutual funds, or the equity markets in general. But on an aggregate basis, gross financial savings have come off in the last 7-8 years, and net financial savings, as you would be aware, in FY23, it was the lowest in many decades. A part of that was because gross financial savings are not picking up, but a larger part of that is because household borrowings are going up, which is where we started this discussion.
Got that, Nikhil. Lots of other questions, but out of time, so come back more regularly. We'll invite you. Thank you very much for joining us here on this edition of Bazaar. Well, that's Nikhil, Chief Economist at Motilal Oswal Financial Services. Markets